Stimulus? Is this science making advance and leaps and bounds? We're going to cover all that. We're going to cover what the market's telling us right now in terms of important levels. Cover some of the economic headlines, as I mentioned. We'll get into some of the earnings came out today. Retail, is actually doing a little bit better than I think we had thought initially heading into this earnings period. And then we will give a little bit of a demo from your site, and then hopefully maybe even get into some of the names that are coming out today after the close. Salesforce, Costco, some bigger names there. Different industries, but still bigger names all the same. All right, well, before we do any of that, let's get into our disclosures. First off, Tony and Options Play are not affiliated with Charles Schwab and Company. I, however, am. Joe Mazzola. I am a part of Charles Schwab. But anything that Tony and I do talk about today is really for informational purposes only. Please, if you're going to make your own decisions as an investor, do that. We're going to show you some of the research that's available on schwab.com today. We're actually going to hop over to Tony's website as well, too, on Options Play, so we get a chance to see all that as well. That being said, our agenda, market recap. Tony, we are back up at some early March levels in some of the broader indexes. We'll hop over to Street Smart Edge momentarily to show everybody that. I do want to talk about some of the sector performers because it's interesting, Tony. We're seeing a little bit more of maybe a diversity in some of the market movers. It's not all FANG anymore. We're starting to see a little bit broader move in some of the other sectors, and so that is interesting. I want to get your take on that when we get into that. I also, like I said, I want to talk a little bit about some of the economic headlines. What came out today. We had GDP, we had jobless claims, we had durable goods, pending home sales. So a couple really big indicators came out. Some of them not so good, but yet the market continues to rally. So we'll get into all of that. And like I said, last but not least, we're going to analyze a couple of the names that are coming out today after the close to look to see kind of what maybe the options market's pricing up. And then, Tony, if you're okay with it, maybe we'll take a look at some different strategies that we can apply in advance. So let's do this. Let's go over to Smart Edge, and we'll kick it off with, I have it on the VIX, but I want to go to the S&P because, I mean, the two, they kind of go hand in hand, in that when the S&P tends to go up, the VIX tends to go down, although today is a little bit different. The VIX is holding in a little bit. You and I were talking about that earlier, but let's start off with the S&P. All right. I want to go back. I'm going to draw in some of these Fibonacci retracements. And for those of you who don't know how to do that, I'm going to open this up right here. Click on Fibonacci retracement. I usually start at the bottom, my way up. There you go. And we have moved past, what had seemed to be some resistance levels for a while here, and the one of them was at this 38% level, and that happened to coincide with the exponential moving average on the 200-day. There had been some resistance right around 29.50, but wow, once we got through that, it's been off to the races really for the last week or so. We overtook the 200-day simple moving average yesterday and held on to those gains, and here we are continuing to move forward. Yesterday was an interesting day though, Tony, because we opened up a little bit, sold off quite a bit, and then, some positive news from the semiconductor industry really pushed us forward throughout the end of the day. What's your take on that?
Yeah, so overall, this market has predominantly been a fairly range-bound market for the better part of about a month. And then early last week was really the first time we sort of saw a bit of a breakout, right? A lot of that was on some of the rhetoric from the Fed president on 60 Minutes. Also, a lot of the optimism on the COVID-19 vaccine that brought us higher last Monday, but that kind of faded throughout the week. But this Monday, we started to push higher. And that was really the first time, like you said, where we saw some broader participation in the markets, not just technology leading this higher. We saw financials higher. We saw utilities higher, a much broader move. Even small caps joined the rally. And so this is all supportive of this current breakout that we're now seeing, as you mentioned, above the 200-day moving average, above 3,000, which is a major resistance level on SPX that goes levels all the way back to April of 2019. So everything right now certainly looks in a substantially more bullish state, despite the fact there's a few things like such as the momentum right now is still looking fairly weak at the moment on subsequent rallies. So there's some signs of concerns, but from all intents and purposes, we're very much in a bull market right now.
Yeah, no, and I think this is one of those markets where we're not necessarily turning a blind eye to the news that's coming out, but it's one of those markets where it's a sentiment-based market in that when you have the ability to rally off of good and bad news, that tells you that sentiment's pretty positive at this point. Because there are plenty of times, right, in the past where we've seen, good economic news and the market would pull back. I think a lot of that had to do with the fact that people were concerned that as the news became more positive, the Fed might be a little bit more hawkish. But I don't think there's any concern about the Fed being hawkish at this point. If anything, it's as a Fed bazooka type blast rally that we've seen really basically since that 2200 level back in the S&P and then, as you mentioned, the weekend before last, when Powell was on 60 Minutes, that really gave a nice little jolt on that Monday to the markets. We've really just been taking off ever since. That was kind of the impetus that we needed to get out of that range. And like I said, it's been all systems go at this point. Let's take a look at not necessarily just the S&P, but the Dow as well. We'll kind of go through all these. I mean, they're going to be similar. But what's interesting, though, is, while the S&P is above the 200, the Dow still is not. You got a little bit of room up around, say, 26.3 is where we might run into some resistance, at least at that 200-day moving average. And what's really interesting about that, I mean, these are levels that when you talked about a V-shaped bounce in the market, I think that initially there was hope for that to happen, and then that hope faded very quickly as we pushed down as far as we did. But incredibly, I mean, we are literally about, 2 months off the lows that we put in March, and we have almost gotten back to where we were mid-February on the Dow. Now, it's going to be interesting to see kind of how the Dow performs as we move back up towards some of these levels, because the Dow's not nearly as tech heavy. The S&P, you could say, isn't tech heavy, but when you talk about some of those FANG names representing about 22% of the market cap of the S&P, then they do have some outsized moves there. So that's going to be an interesting one to keep an eye on. The Nasdaq itself. So I'm going to bring up the composite, and go ahead. Feel free to comment on the Dow if you'd like.
I was just going to say the Nasdaq. You're basically back at January, February highs, or just spitting distance from January, February highs. It is incredible that we are back at these levels. If you asked me 2 months ago, do I think we'd be back here? I would have said absolutely no.
And the fact that we're up on the year, 6%, on the Nasdaq, given where we came from, it's pretty incredible. And that's where, initially there was a lot of concern, I think, because it was so concentrated in those 5 names that we were concerned whether or not there was opportunity for a broad-based rally to occur. And then after some of the money, I don't want to say moved out, but moved back in towards some of the beaten up names, you saw a big push in energy. You started to see this week a big push in financials. I mean, financials, an incredible story this week after basically being kind of the forgotten sector that really hadn't participated in much move at all. Now, that makes sense when you take into consideration what the 10-year yields been doing, and then kind of even what the 5-year yield was telling us last week. Bond traders were betting on a potential for negative rates at the end of the year in the 5-year. A lot of that started to change a little bit, though, as you started to see the financials catch some footing here at the end of last week, and really had a nice run this week up until today, where the financials are down 52 basis points, right, or so in the XLF. I mean, basically, they're up about 6% on a 5-day trade. And then when I look at, as I draw those Fibonacci's, because somebody did ask about this, I'm going to go ahead and draw those in again. As I draw these in, we are coming up right to that 50, right there, right at that 50% retracement. And basically, the question was, how do you determine the Fibonacci retracement from high to low? Does it make a difference? I tend to start at the low and go to the high within the time frame that I'm looking at. It's a small difference, I think, if you take it the other way around, but not much. But if you look at the difference between our Feb highs and our March lows, it's literally taken us right back to that 50 level, having some difficulty getting back above that. So we'll see. That could be some resistance going forward. But you take a look at some of those financial names, they've had a really good week, haven't they?
They have. I will say financials is one of the only sectors that I had any short positions in. Not looking very good this week. I'm still trying to decide whether I'm going to hang on to these or I think financials are going to roll over. Predominantly my thesis for short financials, or rather selling call spreads on financials, was really a yield play. Um,
Mm-hmm.
because and right now yields haven't moved at all, but we have these financials that have rallied. I think this might be another time to sell some call spreads and fade this rally.
Well, that makes sense too. And let's say that you had purchased some of the bigger financial names, right? Um, if you ever want to know what makes up some of these ETFs, you can just right-click in here and go to research, and then you'll get an idea of the components, right, that make up some of these ETFs here. So if you go to portfolio, I mean, basically 14 and a quarter is made up of Berkshire, and then another 11 and two-thirds is made up of JP Morgan. So between the two of those, you've got more than 25% of the XLF made up between those two names. So if you're ever curious about the construct of some of these ETFs, it's a real easy way to just do that research. Just right-click in there. There's other basic research in here as well too. Some of the different ratings from some of the different ratings agencies out there. Some of the different metrics if you want some basic metrics in here. But it's intuitive and it's quick and it's right there available to you. You can always take a step further and go back to that right-click function I just showed you, and then actually go into, instead of research XLF, research XLF on Schwab.com if you want a little bit more, a deeper dive into some of the fundamentals behind the companies that make up those portfolios as well. All right. The XLF itself, like I said, and I do tend to agree with you. I think the move's been a little bit too far, too fast, given what we've seen in the 10 years. So I'm going to bring that up real quick because I think a lot of times when you can't look at one without the other when you're looking at these yields. Let's move this to a little bit of shorter time frame. There we go. So seems like we found a bit of a bottom, but we've also found a bit of a range too in these 10-year yields. Anywhere between that kind of 60 to 70 basis point range has been where we've really been sitting now, going all the way back to the beginning of the month, even really all the way back into April. If you kind of look, the lows that we put back in April, we're right around that 60 basis points. And we're kind of at the high end of the range right here. You see some consolidation right around this area. And then one thing that's kind of nice is when you have that amount of volatility in the fixed income market, which a lot of bond traders just aren't used to seeing that much volatility. That's usually more of what you see on the equity side. If you get a chance for the bond market to kind of take a little breather a little bit and start to digest some of the economic data, then a lot of times that kind of matriculates over into the equities markets as well too. I've always tend to find it that the bond market really seems to kind of pick up on that data a little bit more forward looking, and then the equity market catches up. So as you started to see some of the some of these price stabilization kind of heading back all the way to April here, that's when you really started to see the equities kind of bounce back up a little bit. And once that occurred, it really took up until this week before you started to really see some of the financials participate. But even going back to the earnings that we had, Tony, with financials, they weren't bad. And one of the things that I noticed a lot of the companies were talking about was their reserve requirements that they were keeping on hand in terms of cash on hand for potential bad loans. Is that something that you're going to be on your radar over the next couple of earnings periods?
Absolutely. And it was actually surprising to me that when financial earnings came out that they didn't rally with the market. I was actually a
Right.
little surprised by that. But definitely loan book is something that's going to be we're going to scrutinize quite a bit. I don't have a lot of short positions right now because of how bullish the market is. I just have some specific names in the financial space that I think were weaker that I put
Mhm.
on a few short positions in. But at this point, things are starting to turn around. I'm cutting losses on those trades. I'm going to reevaluate whether it's time to take another short position in these names.
Well, that's a good point, and maybe you can explain that a little bit. Let's talk about You talked about maybe selling some call spreads. If you are closing out a call spread, do you close it, or do you look to roll up and roll out a little bit? I mean, we can get in a little further depth, but just for a higher level conversation, how do you normally close a losing option trade?
With a call spread like this, I would simply just close out both legs. And, that goes into a little deeper conversation around just my trading philosophy and how I go about taking losses and not holding on to losses and try to roll them to get them back to winners. Really comes down to thinking about how you analyze your portfolio as a whole and not just each individual trade, because individual trades, sometimes you get tied up in them. You get emotional about a trade. You think I should be right, and you try to do things like continuously roll a call so that you can try to get yourself back to break even. And that's kind of how you sometimes find yourself in a bigger hole than you originally intended to. So I always like to cut my losses on my original trade and then detach myself emotionally from that losing trade and decide, should I want to place another new trade without kind of that emotional attachment to that losing trade, if you will.
That's very well put. All right, a couple questions here. And part of it is around some of the economic headlines that have come out. And then tomorrow we have some economic headlines coming out as well. But just give you guys a little bit of a background in terms of what came out today. We had weekly initial jobless claims. They're up, but they're decelerating. They are still above that 2 million mark. And, so while we are starting to see that kind of move in the right direction, the 4-week moving average did fall by 436,000 to 2,608,000. So while that still is moving in the right direction, we're still over the 2 million mark. And these are, it's funny, Tony, because one of the things that I'll tend to do when I prep for a lot of these closing remarks segments is I'll go back to some of my old notes. And I was going back to some of my old notes from April and looking at some of the jobless claims when they first started to tick, and that 600,000 was a really big number.
Right.
When that first jobless claim came out, 600,000, basically the highest we had seen in years. And I mean, here, we're looking at 2 million, and we're looking at it as almost I don't want to say a bullish sentiment, but something that's moving in the right direction. Is that just kind of how we're going to have to look at this now? Is that the economy's potentially moving in the right direction, and you kind of take that flash number and you set it to the side, or do you have to look at it in terms of, hey, maybe it's better to look at the 4-week moving average and where that's headed?
I think there's a part of this where you have to step away from the number itself and maybe look at the velocity of the number, right?
Mm-hmm.
Because we've never seen this type of unemployment ever, right? We've certainly never seen this type of velocity. So, but we also at the same time knew that despite this very high number, we were expecting that it would come down significantly faster than previous recessions as well. So you kind of have to take both. But I think that at this point, the market is really looking more so at the velocity itself rather than the numbers. So how quickly are we getting back to normal? How quickly are GDP numbers? Because we know everything's going to be really bad, worse than we've ever looked at. So we don't really have any history to look at before, but we look at that velocity, and I think that's the number to pay attention to right now.
Yep, fair enough. That makes a lot of sense. All right, continuing claims, they did drop by 3,860,000 to 21,052. Still an unfathomable number, but they are moving in the right direction. Q1 GDP was revised lower to a 5% contraction. So once again, this goes back to that question. You see these numbers, and it's really hard to kind of put some bullish sentiment on it, but the market continues to rally into that. Personal consumption was revised to a 6.8% decrease, and that was actually better than the expectations of a 7.5% drop. Durable goods orders fell by a smaller amount, expected 17.2% month over month. And durable goods they're important because these are the higher ticket items that we purchase, homes, things like that. And so when you look at that and you're noticing that that is coming in a little bit less than expected, that is a move in the right direction. Although pending home sales did fall 21.8% month over month in April versus the projection of a 17.3% fall. I want to take a look at that real quick in terms of the home builders, because home builders have been on a pretty good ride. I mean, they really have. Toll Brothers came out with Q2 earnings of 59 cents a share. They beat expectations of 45 cents. Revenues declined almost 10% year over year, 9.9% year over year to 1.6 billion. That was in line with forecast. They're not going to give you full year guidance because that's the environment we're in right now. That's kind of standard right now in any industry, really. But they did note that net signed contracts in the first 4 weeks of May were down 37% year over year. They were encouraged by recent deposit activity. So you look for trends in the market, and I don't want to say that the home builders, kind of put the bottom in, but you look at that move off the bottom from say 25 or so all the way up to 44 on the home builder index. That's a pretty substantial move, and you just wonder at this point how much of this is already priced in. How much more do we have to go? Because the bottom line is we're basically almost within spitting distance of of where we were, back in February before we had the big pullback. When you look at a chart like this, does this seem a little too far, too fast?
Yes and no. There were certainly signs of exhaustion on every single rally, if you will, but they all, you had a few days of a bit of a sell-off. It bleeds off that momentum, and that provides that quote unquote buy the dip opportunity that we've continuously utilized over the last, let's just say, 2 years or so now. And this is really the reality of trading right now. Even when we opened up Monday significantly higher, a lot of the tech names were substantially down. A lot of the hot tech names like Zoom and DocuSign, a lot of the names that drove the rally initially had 5, 6, 7% pullbacks over the last couple of days, and that was the opportunity to go long. And all of those stocks rally significantly here today. So yes and no. We are going a little too fast, but the momentum keeps bleeding off. Like as you can see here, every time Zoom has those pushes higher, they pull back all the way to that. Is that the 50-day moving average, the red line?
Yes, that's 50. Yep, exactly. It's been a good buying opportunity on the 50, hasn't it?
Exactly. So this is a new reality that we're trading, and from my perspective, it's difficult to continue to pull the trigger on long positions when you have a market that seems completely at odds with all the economic numbers that you're currently looking at. It is certainly difficult to continue to pull the trigger on long positions when you know that these stocks are trading at pretty extreme valuations, not quite dot-com bubble valuations, but pretty extreme, certainly beyond the January, February highs in terms of valuations. So that's why, from my perspective, in order to continue to take long positions in these types of stocks, number one, timing is extremely important. Waiting for pullbacks when you have these type of 5-6% pullbacks over a couple of days, that is an opportunity to go long. But when you go long, I'm using strategies like calls and call spreads to utilize that long exposure, but more so in a way with limited risk, because I think that at this point, I don't know what's going to cause the next sell-off, whether it could be, something goes on with Hong Kong. There's a lot of geopolitical risks. Perhaps there's a second wave of COVID-19. Whatever that risk is, I simply cannot predict it or envision it. So my exposure is always going to be long, but do so in a way with limited risk using option strategies.
That makes sense. And so I just went through kind of a catalog, so to speak, of some of these stay-at-home stocks that had done fairly well over the last couple months. And these aren't recommendations by any means. We're just kind of highlighting some of the names that have done well and some areas where some investors have stepped in and bought these. And we recognize on some of these that is the 50-day moving average had been a pretty good way to kind of look at entry points for some of these names. So good questions there from everybody. There's a good question about some secular changes, Tony, and I've been talking about these for a little bit. And I realize that these are, these are things that are going to play out over years, right? This is not a 2-week trade or a 2-month trade. But when we talked about the Toll Brothers and the home builders, you live in New York City, correct?
Correct.
Okay, so but there's a lot of people that are starting to make that transition out to the suburbs a little bit, just because of what we're seeing in trends, right? In business trends, in terms of corporate real estate, in terms of the work at home technology that's being offered. Some of the names that we had looked at just a couple minutes ago, like Zoom Media, Is this something that you think over the next few years might be a trend that you continue to see potential for, the home builders, for some commodities like lumber, for these and Home Depots and your Lowe's and just different plays like those to continue to be potential secular plays as we might see maybe a change in how we approach work?
I 100% believe that. If you look at Facebook announcing that they're going to be moving a lot of their workers to working from home, I think that's just the tip of the iceberg. I think you're going to have a lot of companies revisit and think about, do I need to have, all these corporate expense accounts flying people back and forth, or can I just have, Zoom at $50 a month replace that, right? Working from home, absolutely. I think commercial real estate is going to be a net is going to be hit by this, but there's a lot of technology stocks that are going to be a net beneficiary of this, potentially home builders as well. Like you said, lumber, there's no shortage of specific niches that I think are going to be net beneficiaries of us coming out of COVID-19 and realizing that things have changed and things are not going to go back to normal as many of us may want them to go back to normal. It's just not going to be the same, and there are definitely going to be opportunities as a result of that.
All right, well, let's do this then. I got one question for you, and this is from Robert in New York. He says, Tony, really enjoy listening to you, but got to let you know that your hardware is fantastic. What type of headset are you using? It must be much better than mine.
I'm using AirPod Pros, which I'm
There you
a
go.
fan of Apple as well on that front.
There you go. All right, Robert, I hope that answered your question. All right, Tony, I'm going to do this. I'm going to hop over to options play, and then maybe you can walk us through maybe some of these maybe some of these long call plays. We got some questions coming in along the lines of, if you do want to stay in the market, but you are concerned about pullbacks. And look, I think the way that you set that up, it makes a ton of sense, because for a lot of people, they say, look, we want to stay long, we want to be bullish. It's hard to buy in at these levels. What do we do if we've missed a good chunk of that move? How do we have risk-defined type trades? And I think it's a nice little setup for maybe where things they could find here on options play.
Yeah, so why don't we take a look at a stock like Snapchat, just for example. This is a name that I quite like. It bounced off the 20-day moving average earlier this week. It's about to break out above that $18 level. We've seen a lot of stocks have this type of consolidation pattern, then break out to the upside. A lot of stay-at-home stocks, if you will, like Electronic Arts, Take-Two Interactive. So if you apply that same similar type thesis here, what we can do is we can take a look at how we can utilize options to play for continuation or potential breakout here, but do so in a way with relatively small amount of risk. So if we look at the three strategies on the right-hand side, options play will always display to you three strategies, regardless of whether you're bullish or bearish. So right now we're looking at bullish strategies. So we'll show you to buy 100 shares of that stock will cost you $1,800. To buy a call option will cost you $152. Buying a call spread will cost you $130. Let's start with just the call option first as a simple option strategy. So first of all, $152 on an $1,800 contract means that you're risking roughly about 8% of the underlying stock price to take a bullish bet on Snapchat. Now, the reason that we generally avoid just buying call options is because call options many times are expensive, right? So for $1.52 on an $18 call option, the stock needs to move up to about 19.5 just for this call option to break even, which is a pretty bullish move, if you will, considering the stock has been trading within about $1.50 range for the last month. This needs another $1.50 to the upside just to break even. So that's why we typically like to use the strategy on the right-hand side, which is the call spread. This is where we're still buying the $18 call option. We're still paying $1.52. But if you click on the modify button for the vertical spread, Joe, what you see here is that we're buying the $18 call option for $1.52, but we're selling the 21.5 call option for 22 cents. Now, 22 cents doesn't sound like a whole lot, but when we reduce our total risk and cost on the trade by those 22 cents, now instead of risking 8% of the underlying stock, now we're only risking roughly 7% of the underlying stock. So we're reducing our cost basis. We're reducing the risk on our trade. We're reducing the amount of capital that requires to get into the trade. So Joe, if you can click on at the very bottom, there are 5 dots. If you click on the one on the very left, this is our P&L simulator. This allows us to simulate, well, what happens if Snapchat does break out to the upside? How much potential return do we have? But more importantly, it also lets us look at what happens if Snapchat pulls back. What if something happens and all of these stocks starts to pull back? Let's first start off with the downside, right? So if we use the target here, let's say we think, what if Snapchat declines back to $16? How much money do we risk? This is really the first step that I think we should look at. And you can use the price slider or just type it in, $16.
There you go. Yep.
So first of all, what I want to compare is, and this is really highlights why I prefer utilizing options to take these types of strategies, because if something happens and markets really pull back, I want to do so with the smallest amount of risk possible. If I had bought 100 shares of this stock, I would be down about $236 if the stock pulls back to 16. If I bought the call option, I risk 152. If I bought the call spread, I'm only risking 130. So my goal always, whenever I'm trading anything, is trying to minimize risk first, because then that's the only way I can maximize my upside, is by first minimizing risk. So that's why I would trade a strategy on the right-hand side. And then we can now look to say, well, what happens if Snapchat breaks out? And let's say it goes up to $20 or $20.50. As you can see here, because I'm able to reduce the cost of my trade from $152 to $130, those $22 improves my return from 130% return on just the simple call option, which is arguably a very good return if I do make 130% return if Snapchat rallies up to that $21. But the $22 that I save by selling the 21.5 call brings my cost basis down to $1.30, which boosts my returns from 130% to 169%. So this is really why we utilize strategies like this to really maximize our potential gains. And we do so by reducing our risk and reducing the capital that it requires for us to take this bullish view, if you will, on Snapchat. So that's just a quick example of how we utilize options and how we utilize options play to help you find these types of strategies, because the tool itself only requires you to enter a symbol and whether you're bullish or bearish, and will present to you starting points such as this call and this call vertical to allow you to explore and learn more about options trading before you pull the trigger on a strategy here in your account.
So let me ask you a couple questions about this, because this it's a nice tool to look at kind of the risk reward here. You know, the stock trading 1828, do you tend to kind of look at the monies or slightly in the monies if you're going to buy a call or a vertical spread? I know some people, some traders out there like to buy out of the monies because they're looking for the higher potential return on risk. Problem is, though, as you mentioned a little bit earlier, is that, yeah, even though you get that, that potential pop from 20 cents to 30 cents, which, in terms of rate of return is a 50% return. The problem is, though, it's got to move fairly quickly within that short amount of time for you to get that pop. Is that why you are looking at the money strike to go long, or slightly in the money strike to go long? Is that why you're starting off there?
Yeah, so there's a couple of reasons why we do that. First of all, we always start off whenever we're buying an option, whether it's a call or a put, we always do slightly in the money. About 50, 55 delta is usually a good starting point for us. And if you use options play for any strategy, that's usually where we start. And the reason for it actually comes down to two factors. It's one due to time decay and another one due to delta or rather gamma, I would say, which is the change in leverage. So the reason that we buy a call option is because we want the convexity. We want the asymmetrical risk so that if we're right, we get paid more and more for that for that contract. And if we're wrong, we actually have a limited amount of risk to the downside. So that's what we call convexity. It's the asymmetrical risk that we get with a call option. Now, when you are buying something that's either very far in the money or very far out of the money, the gamma or the change in leverage is actually relatively small. So when you buy an out of the money option, let's say we buy a $21 option on this, it will be significantly cheaper. And you can do that, Joe, if you just want to hit modify here for the call option and change that to, let's say, the 21 strike. As you can see here, the 21 strike is only 46 cents, right? So it costs a third of the premium of that $18 call option. And a lot of people will say, well, why not buy the $21 calls? I can buy 3 times as many contracts. And this way, if the stock moves, I can make a higher return. And that is certainly true, but you require this strategy requires the stock to make an astronomical move to the upside, where you have about a 15-20% chance of that ever happening, where basically you have an 80% chance you're going to lose 100% of your premium. That's why we don't really like to buy those really far out of the money options or even really deep in the money options, because a deep in the money option also works against you if the trade starts to go in the opposite direction. It doesn't decrease the leverage fast enough on that trade when the trade starts to go against you. So that's why we always start slightly in the money, so that if the trade starts to go in our favor, delta gets ratcheted up to about 70, 80, so that we're making 70, 80 cents on the dollar. And if the trade goes against us, it quickly declines into that 20 and 30 range, so that we're only losing 20 to 30 cents on every dollar the stock continues to move lower. So those are the reasons why we generally start with at the money options.
Yeah, makes a lot of sense. And for those of you who are hearing the term gamma for the first time, Tony, we could talk about that for an hour, right? And convexity and how that changes. But really, basically, gamma is telling you how many deltas you're picking up on the way up if you're long a call. So if I'm buying an option that's got a 60 delta and it's got basically a gamma that's right at the money, and it's got gamma of 15, that means for the next dollar move I picked up another 15 deltas. So it's just telling me how many deltas I'm gaining for each dollar move in the stock. And if that stock's moving in the right way, this is where that whole leverage component really works out, is because not only am I picking up the potential dollars from those deltas that I'm long, but at the same time I'm getting longer and longer deltas as the stock goes up, and those are working more in my favor. Where it doesn't work out, right, is if the stock pulls back. But as you mentioned, leverage is a double-edged sword in that, yep, it helps when it's moving in the right direction. It hurts when it's moving in the wrong direction. However, part of the risk management of this trade, and I think this is important, we talk about kind of the entry, the exit, and the maintenance. But one of the entry considerations is, if you're going to buy 100 shares of the stock Snapchat itself, you're going to spend $1,800. That doesn't mean you spend $1,800 on options. Does that make sense, everybody? Like you don't need to look at it and say, well, I was going to spend $1,800 on the stock, so let me spend $1,800 on the option. And boy, look at the potential that I have. No, what I think you should do is kind of look at this and start off and say, how much am I willing to lose on this trade? And I know that might seem like a negative way to look at things. It's not. It's a really pragmatic way to say, if I'm wrong, if everything's wrong, what is my exit going to be? How much am I willing to lose? Some people say 50% is a potential losing target for me. And if I say, well, I'm willing to lose say $500 on this trade, and I'm willing to get out when it's down 50%, well, then that tells me that I'm willing to invest maybe $1,000 on the trade if I can get out on a 50% loser, right? That's another thing to consider as well too. But you can set all that up in your bracket orders, right? You can set up a stop order on these individualized options as well. So just different ways to look at this, and I think that's an interesting one to look at, especially kind of given what the stock's doing today. It's having a nice day, up 7.5%, kind of breaking out of this level right here, right around this $18 level that had been some resistance. We'll kind of see where this one continues to go. Now, Tony, one of the things I noticed is that this is a July 10th expiration. It's a weekly option, and do you tend to look at a strategy when you're buying an option and say that, okay, if my expectations for the move If my expectations for the move is that it's going to move within, say, the next 4 weeks, then let me give it a couple extra weeks to allow that to happen. So what I mean by that is there's some people that'll look at things and they'll say, well, the expected move of the stock is, $10 based upon the range that it broke out of before. Yeah, does that happen? I don't know. I mean, sometimes it happens. I think it's a little too simple of a way to look at it, but let's just say that's the case. Let's say in this example, the expected move is, we look at the bottom here from 16 to 18. That's a $2 move, and we're hoping to get another $2 move from breaking out of here. That's taking you to 20 or $21 if it's a $3 move. And let's say you saw the setup start in mid-April, and here we are now, third week of May, so that's 5 weeks. Is that kind of how you're setting this up? Or are you saying, like what helps you determine the 21.5 strike, and what helps you determine July, I guess is what I'm asking you here.
So great question. So let's first start about the on the expiration side. We, as option buyers, will typically never want to hold on to that option in the last 2 to 3 weeks towards expiration, because that's really when time decay ratchets it up, and you will start to see your profits or your gains on an option start to evaporate very, very quickly. So that's why we always extend at least 2 to 3 weeks beyond our time horizon, because we expect to get out of that trade 2 to 3 weeks prior to expiration at the longest. So that's why, generally speaking, we go out at least 45 days. Most of my trades, I would say, don't last more than 2 to 3 weeks or so, but I always give myself 45 days going out, and that's how we found the July 10th expiration. You could always go out to the normal July expiration, which I think at this point is roughly about 50 days to expiration. As far as the strike prices go, that's a really good question. So the reason that we sold the 21.5 is actually because the 21.5 for the July 10th expiration is the one standard deviation move, which means that there's only about a 15% chance that Snapchat will be above 21.5 by June 10th. And that's how we chose the 21.5 strike to sell, because we're basically saying that we want to collect enough premium to offset the cost of that long call, but we don't want to cap the upside of our call option too much. And that's really why we sell an option that's relatively far out of the money. It collects roughly 10-15% of the cost of the long call, which reduces a significant amount of risk and actually amplifies return if the stock is correct. And even if the stock overshoots that 21.5 by 20, 30, even 50 cents, usually it still is going to outperform the just the naked call, if you will, or just buying that outright call. So that's why we choose that 21.5.
That's a great point. Let's take a look at one more name here. I know this is one I'm kind of just putting in here for you. It's not one we talked about, but it does have earnings. Salesforce. Kind of take a look at what we might be looking at. I mean, the stock from a technical perspective looks pretty bullish, kind of given off the lows that we've seen. Do you get nervous doing things like doing some of these option strategies going into earnings? Do you kind of shy away from that? I don't mean nervous, but I'm saying, excuse me, do you tend to kind of shy away from earnings plays, or do you like to take advantage of some of the increased implied volatility as you're heading into earnings?
No, I love playing earnings, especially over the last few, I would say, quarters, where predominantly we've had a strong directional move from the markets. I've been predominantly, at this point, if you look at a lot of the earnings, we haven't seen some huge jumps to the upside in a lot of these tech names. You've kind of seen fairly muted moves to the upside, with the exception of maybe PayPal. And Salesforce earlier today it started to break out above that 183 high, if you will, but seems to have pulled back here. I've been selling a lot of premium going into these types of events. I'm predominantly selling put credit spreads. So on a trade here like Salesforce, if you go back to the trade tab on CRM, and if you click on, let's go on the, let's click on modify for the stock leg. And then use the strategy constructor below it where it says long stock right now. Click on bullish, and then scroll all the way to the bottom, the short put vertical. So with Salesforce trading at 181, if I was bullish on Salesforce going into earnings and I thought it was going to pop a little bit higher, but not substantially higher, which is predominantly the types of views that I've been taking going into earnings this particular cycle, I would
Mm-hmm.
look at selling maybe a 180 put and then buying back something in this particular range, maybe the 170 or 167 and a half. And then if you click on bid ask versus the midpoint on the right above that, because the bid ask spreads on these are pretty wide. So here
Right.
you chose the 160, 170, 180s, and it collects $4. And this is a $10 wide credit spread. So this is collecting 40% of the width because it's $1,000. If you think about a $10 wide credit spread multiplied by 100 shares, that's $1,000. Here you're collecting $400 out of that $1,000, which means your max risk on this trade is $600. But the max risk here is only if CRM is below 170 at expiration. I will say that normally with earnings, I would trade something a little shorter dated than July 10th, but I think this is still suitable as an example purpose to show you that, on credit spreads like these, especially something that's already, $1, $1.50 out of the money, you wouldn't normally expect to collect this much premium. The general rule of thumb is that you try to collect about a third of the distance of the width. Here we're collecting more than that, 40%, and it's out of the money too. So this is really giving you quite a bit of an edge here because your break even on this particular trade is at 176. If you click on the options play score, it'll show you your break even price is at 176. Yep, just click on the options play score. And so your break-even price here is 176. Salesforce is at 181. So you basically here have about a $5 buffer on earnings, right? If Salesforce stays where it is, moves higher, or even moves a little bit lower, this strategy is going to be profitable by expiration. So these are the types of plays that I've been utilizing going into earnings and taking advantage of the relatively high implied volatility with options.
All right. Well, very well said, Tony. There's a couple of other questions I want to get you real quick. We'll bang these out. First one is from Al, North Carolina. He says, is it accurate to say gamma is the delta of the delta, Tony?
It is the second derivative, so it is the slope of the delta curve. So did he say delta of delta?
Delta of the delta. I think that's fine. We give him that answer.
I think that's a pretty good, accurate description. But to be more accurate, it's a second order derivative of delta.
That's right. We'll give you that one, Al. We'll give you that one. The other one is says, Tony, I see bullish and bearish sentiment. Does options play offer trade analysis if one is neutral? And I guess my thought would be, what about income? Would that be a way to kind of look at it from a neutral perspective?
Yeah, so the income strategies certainly are neutral with whether you own the stock or if you want to own the stock, but credit spreads, the ones that I just showed you using selling a put credit spread on CRM, that's an example of a